Welcome back to accounting. I want you in this problem to prepare journal entries to record the following transactions for the month of January 20X1. These are all of the transactions for this company called XYZ Corporation in the month of January. What I want you to do, and there's 16 of these transactions, entry. It requires you to analyze what happened to assets, liabilities, owner's equity, whether they were increases and decreases. And so let's go through and walk through each of these transactions individually and make sure that you got them right and that you understand how we did come to the journal entries that we did. First, in this transaction, owners contributed $10,000 of cash to the company in exchange for 1,000 shares of stock in the company. Now again, you did not need to do this. We asked simply for the journal entry. But I would like to show here the analysis associated with this transaction. In other words, what was the effect on assets, liabilities, and owner's equity? In this particular case, the company is receiving $10,000 of cash. That's an asset. It's increasing. An increase in an asset is reflected as a debit. The company isn't borrowing this cash or resources. What they're doing is receiving a contribution, a capital contribution from the owners. In exchange for that contribution, they are issuing shares of stock, which are simply evidence of the ownership interests or rights of those investors. The value of their contribution, or the amount that they have contributed in exchange for that, is the amount of capital stock, or the valuation placed on owner's equity. This is a $10,000 increase in an account referred to as capital stock, and because owner's equity is increased on the right, we will credit capital stock. The journal entry is debit cash and credit capital stock. Now, I do want to take just a moment and maybe expand on this entry for just a moment, because many students sometimes get a little confused here. Maybe that's because in the world, sometimes we refer to companies that are issuing stock as companies selling their stock. The fact of the matter is that businesses or companies do not sell their stock. They may issue stock to investors in exchange for capital contributions. But a company's stock is not an asset of the company that they then turn around and sell. Companies don't own themselves. People or institutions own companies. Peoples and institutions own and hold stock. For an individual investor, when they in fact buy stock or make a capital contribution in exchange for stock, they are exchanging one asset for a different kind of asset. An investment in cash at the bank in exchange for what is now an investment in stock in a business. But from the business's standpoint, as a separate entity, the business is receiving cash and not selling an asset. They are simply receiving cash, receiving it in the form of a contribution for which they are providing ownership rights. That's referred to as capital stock. Okay, let's look at the second transaction. In this particular transaction, $25,000 of inventory was purchased on account from suppliers, sometimes referred to as vendors. In this particular case, has the company received any assets? Again, looking just at the analysis of the transaction, well, yes, inventory is an asset, and we have received inventory. There's an increase. Increases in assets are shown on the left or debit side. We've purchased this inventory on account. That means we're not paying for it today. We're going to pay for it in the future. But at this moment, we have incurred a legal obligation that requires us to pay in the future. This is a liability by definition. We're increasing that obligation by $25,000 referring to it typically as accounts payable, and an increase in a liability is shown on the right or credit side. The journal entry is to debit inventory and credit accounts payable. The third transaction was $1,250 was paid to Provo Power as payment of a utility bill for the month of December 20X0. That's last year's December utility bill. We're paying it now, and the amount of the payment is $1,250 of cash. It also says that we were to assume this utility bill was previously recorded as a liability last December. If this utility bill was previously recorded as a liability last December, when it was recorded as a liability, it was also recorded as an expense. In this case, when we pay this utility bill now in the month of January, we are paying a liability. It is not an expense. It has already been referred to and accounted for as an expense. So the entry here is to pay the cash, and we have cash going out, $1,250 of cash, and that decrease in cash is on the right-hand side or credit side. And we have a decrease in a liability. Liabilities are increased on the right and decreased on the left or debit side. Let's go ahead and look at our fourth transaction. Now, in this particular case, equipment was purchased at a cost of $70,000. We paid for that equipment by paying $15,000 in cash now and promising to pay cash in the future by executing a note requiring payment of the remaining $55,000 2 years from now. In addition to that note, or obligation to pay $55,000, which is referred to the principal of the obligation or the note, we will also, 2 years from now, have to pay some interest, some cost associated with borrowing those funds. First, I want to make this point. At this moment, when we buy the equipment and pay $15,000 of cash and also incur the obligation of $55,000, at this moment we have no obligation for interest. The obligation to pay interest will occur as time passes. In fact, if at this moment, immediately following this transaction, I said, you know, I've got the $55,000, I might as well just pay them the full $55,000 now in addition to the $15,000 I just paid and pay for this equipment off right now. If I did that, would I owe, this is an important question, if I immediately paid off the note, would I owe any interest? The answer to that is no. You only owe interest over the time period in which those funds have been borrowed. So in recording this transaction, I want you to remember that you're not going to record interest that's payable because that obligation is only incurred as time passes. At this moment, if your current obligation is that there is no interest payable at this moment. Okay, let's look at the transaction. Did we have any change in our assets as we analyze this? Well, yes, we have equipment coming in. The historical cost of the equipment is the price paid for it, which is $70,000. That's an increase in equipment. Increases in assets are increased on the left side or debited. But we also had an asset go out in payment of this equipment. $15,000 of cash went out. That should also be reflected as a decrease in an asset or a credit to cash. If we look on the right-hand side of the equation, do we have any future obligations incurred as a result of this transaction? And the answer is yes. We have a future obligation to pay $55,000. Yes, we'll have to pay interest in the future, but at this moment, if we were to pay off that obligation, we would have no interest due. The $55,000 we'll refer to as a note payable. And because liabilities are increased on the right, we will credit note payable. Let's look at the actual journal entry. Because equipment is an asset debited, we'll show a debit to equipment for 70, a credit to cash for 15, and a credit to note payable for 55. Now let me ask you a question, which would be another good question for an exam. If I were to ask you, as a result of this transaction, what was the net effect on total assets of the company as a result of this transaction? What would be your response? Well, the answer should be that our assets, net assets, the net of all the inflows and outflows, has increased by $55,000. We had a $70,000 increase in equipment and a $15,000 outflow of cash. Our total assets have increased by $55,000. The right-hand side of this equation tells us how we received those assets, the net increase of 55. We've borrowed them. Now, we are going to pay this obligation in the future, but we're showing that future payment already as part of the cost, historical cost, of the equipment today. Okay, let's move to the next transaction. In this case, we sold some inventory, costing us $30,000 to customers who purchased it on account for a price of $55,000. In this particular case, we sold some of our goods and our customers didn't pay us. We agreed to extend them credit or to let them purchase it on account, meaning they'll pay us in the future, usually within 30 days. In this transaction, have I received any assets? Yes, I have received an asset called accounts receivable. I have a right to collect $55,000 of cash from these customers in the future. It is a legal right that's enforceable because I've actually sold to them and transferred to them various goods, inventory, and they are legally obligated. It is a legitimate asset, even though it's not tangible. It's merely a right. Because that's an increasing asset, we'll increase assets by debiting accounts receivable. We also have inventory going out. The outflowing inventory, amounting to $30,000, will be reflected as a credit, an outflowing or decreasing asset. Well, now in the analysis, did I incur any obligations? Do I owe anything as a result of having sold this to my customers? The answer is no. So the only other place that we can reflect what's happened here in terms of our assets is in the section of owner's equity. Now, have owners made a capital contribution to the business? The answer is no. The owners haven't put any money into the business. What the owners have done, though, is that they are the beneficiaries of earnings of the business. They're the ones who benefit from the profits and have a right to the profits. So owner's equity is affected, but it is not capital stock or contributed capital. What it is it's an increase in the earnings or retained earnings of the business. But that's always reflected through net income or sales revenues less any expenses. What were our revenues? What was the amount of assets that we received as a result of making the sale to a customer? What was the sales price? The sales price was $55,000. That is the amount of sales revenues. Revenues are increased with a credit. But we also had a cost of providing goods or services, an outflow of an asset that represents a cost of providing goods. That is the cost of the inventory. That is an expense which has a reductive effect on owner's equity. We call that expense cost of goods sold, and we'll reflect it as a debit because increasing expenses are increased on the left or debit side. Now let's make the journal entry. Let's show all of the debits, first to accounts receivable. By the way, you could have drafted or written this equation, this journal entry, a number of ways. If you wanted to show both debits first and then both credits first, that would be fine. We simply want to show all of the accounts that are being debited and all of them that are being credited. And here I'm simply showing accounts receivable debit for 55 and sales revenues credit for 55 because of the same amount. There's nothing sacred about the sequence here. But we're also going to show the inventory outflow, an asset, as a credit to inventory, and show the expense to cost of goods sold. Now let me ask this question that I asked before. What was the net change in total assets as a result of this single transaction? Well, if you look at your assets, you had an increase of 55 receivables, but a decrease in inventories of 30. The difference or increase in our assets was $25,000. Why did we get that $25,000? We got it because we sold something at a higher price or made a profit. By the way, this is the simplest definition of what profit is. It's a net increase in our assets as a result of providing goods and services to customers at a price in excess of those costs. So this net increase in total assets here from this transaction is a reflection of our profit in the transaction. Profit is always defined in terms of revenues and expenses, and the beneficiary of that is the owner. Okay, let's look at our next transaction. In this particular transaction, we're paying salaries and wages that were not previously recorded to employees for the month of January. The amount is $7,000. Our employees have worked during this month. We have not recorded the fact that we owe these salaries or wages. We're simply paying them, and now we have to make an entry. In this particular example, given that assumption that we've not previously recorded the obligation and therefore the accompanying expense, when we pay out cash, in this case, reducing assets by $7,000 of cash, we're not going to say that we're recording a liability or paying a liability because we haven't said that we have a liability. You don't want to reduce a liability that's never been established. What we're saying here is we simply had a cost of doing business and we will reflect it directly as an expense. It has not been previously recorded as a liability or an expense, and therefore we're not double counting it. We'll simply call it an expense. Increases in expense are reflected as debits. The journal entry is debit salaries and wage expense and credit cash. Our next transaction indicates that we collected $37,000 of cash from customers that we had previously made sales to on account. We're collecting some of these receivables. In this particular transaction, we are receiving cash. The amount is $37,000, an increase in cash, which would be on the left-hand side, because all assets are increased with debits. The decreasing asset, accounts receivable, because now, in fact, customers are paying off an obligation, we no longer have a right to collect in the future, the 37, because we're collecting it now. So we must reduce the asset accounts receivable by $37,000. There was no obligation incurred, and owner's equity is not affected. Now, many students will say, wait a second, you're collecting cash from a customer as a result of sales. This is revenue. But we have already recorded that revenue when we previously recorded the sale on account. So we're not going to show it as revenue here at this point in time because we've already done that. We are simply converting one asset to a different form of asset with the collection of the receivable. Now, the next transaction, in this particular case, we pay off some of the accounts payable due to our vendors and suppliers. The amount is $22,000. In analyzing this transaction, cash is going out. It's a credit to cash to reduce that asset. And we're paying an obligation. The obligation has been previously referred to and recorded as accounts payable. But we're paying off a portion of that liability or debt, so we're going to reduce it. That's a debit to accounts payable. You know, it almost seems miraculous sometimes how every one of these transactions, not only are the assets equal to liabilities plus owner's equity, but also the debits equal the credits. Our next transaction In this particular case, we sold some more inventory. This time, $7,000 of inventory is sold to customers, but not on account. They actually pay us cash at this moment, and the amount of cash is $12,000. Well, again, the analysis. We have an asset coming in, cash. That's debited. But we also have an asset going out, inventory, that's credited for $7,000. How did we get this net inflow of assets? In fact, the net flow of assets here, you got $12,000 in and is $5,000 increase. Did we borrow that? Or, well, we didn't borrow it, and owners didn't contribute it in exchange for ownership rights. It's simply profit in the transaction to which the owners are the beneficiaries. We refer to that as retained earnings, and we'll define it more descriptively as sales revenues for the amount of the sales price, $12,000, and cost of goods sold, the expense at $7,000. So the journal entry is simply debit cash for $12,000 instead of accounts receivable. We've sold it for cash. And credit sales revenues for that amount, which was the sales price of $12,000. Credit inventory for $7,000 to show that it's going out. And that represents a cost of doing business, an expense, cost of goods sold, which is debited as it's increased. The next transaction, we purchase $1,000 of office supplies with cash. In this transaction, if we analyze it, we know that assets are going out. The assets that are going out are cash, $1,000 of cash, and we'll credit cash. Many times, students would like to and will consider saying, well, are we paying some obligation here? If in fact we had previously recorded the purchase of office supplies and owed it, then maybe we'd be paying a liability. But in this particular case, all I'm doing is I'm going to a store, an office supply store, and buying supplies for cash. So there is no payment of an obligation. Well, these supplies represent a cost of doing business. We need supplies in order to operate our business, so maybe this should be a cost of doing business. But here's the problem. These office supplies are actually going to provide utilization or service or assist us in producing future revenues. I mean, these office supplies at this moment, well, heck, if we wanted to, we could probably turn around and sell them to somebody. Or we're simply going to use them in the future to help in the operating process of our business. Listen carefully, if we have some property, like supplies, you can touch them, it's property, and they have future benefit, they're going to help us in the future. What is that? That is the definition of an asset. All you've really done is exchange one asset for a different kind of asset that's going to provide future use to you. And that's really what we have here. Well, wait a second. Isn't the cost, we're paying out $1,000 of cash, isn't that ultimately going to be an expense? The answer is yes. When we actually use up some of these supplies, if we're buying paper, and when we use up paper, then it no longer will be an asset, and we'll show a reduction of the asset supplies, and we'll call it an expense. But at this moment, all we're doing is exchanging one asset for another. As we use up the asset, then we'll reflect it as an expense at that point in time. So, finishing this transaction, we are giving up an asset, cash, but we're acquiring another or different kind of asset, office supplies, and we'll show that with a debit. The net change in total assets is 0. The entry, debit office supplies, and credit cash. 2 assets. Let's continue with transaction. In this case, the company pays previously unrecorded telephone bills of $1,000. These are telephone bills for the month of January, or telephone bill. And in this particular month, they are going to pay the bill. They have not previously recorded this transaction or this obligation to pay the bill, and they've not previously reflected it as an expense. So when they pay the bill, we will analyze this as cash going out. $1,000 will be a credit to cash, but since we've not previously recorded this obligation, we're simply going to call it an expense at this point in time. An expense is increased on the left-hand or debit side, and the journal entry is to debit telephone expense for $1,000 and credit cash for $1,000. In this case, we received January's rent of $2,000 from a tenant who's actually leasing some office space in the company's building. Now, this isn't what we usually do in our business. We usually, sell goods and services, but apparently we've got a back room or some additional space, and we have somebody who's agreed to lease that or rent it from us. And the amount of the cost of the rent is $2,000. So we are receiving, we're not paying, we're receiving cash from a tenant, and we're actually acting as a landlord. In analyzing this transaction, since we're receiving cash, we'll show that as an increase in our assets. In terms of liabilities, we haven't incurred any obligation or have any liability as a result of this. So really, in terms of who's providing this asset, I suppose it's owners, but the owners aren't making a capital contribution. So the owners are the beneficiaries here of what is effectively some income or profit associated with this rental arrangement. The inflow of assets arising from the providing of goods or services, and the providing of space in this case is the providing of services, is really the definition of a revenue, and this is the price, $2,000. So in this particular case, we're receiving cash, and it represents revenue that contributes to the net income of our business. Revenues are increased on the right-hand or credit side, and so the journal entry is to debit cash and credit something referred to as rent revenue for $2,000. The next transaction is the receipt of $1,000 of interest for the month of January on a note receivable. Let's see if we understand this. If we have a note receivable, that means that somebody owes us and are going to pay us an amount in the future. We don't know the amount of this note receivable, and we don't know the terms of it, but we do know that we're receiving at this time $1,000 of cash from the borrower as payment of interest. This interest represents the cost of the money, or in our case, looking at it from our standpoint, having loaned the money, the income from having provided the loan. As a result, let's try and analyze this transaction in terms of our financial position. We are receiving cash, and so we have an increase in our assets, and that would be a debit to cash. Again, we've incurred no obligation here. We're receiving something as a result of having provided goods or services. Now, the service that we've provided here really is that we've allowed somebody to use our money for a period of time, and they're going to pay us for that. So I guess effectively we have rendered a service and received some fee or payment in exchange. The amount of that fee or payment is referred to as revenue. We'll call it interest or investment revenue. And since revenues are increased on the right, we will credit interest revenue. The journal entry is to debit cash and credit interest revenue. In the next transaction, we pay the previous year's income taxes, which amounted to $5,000. Now, let's make an assumption here. Let's assume that these taxes have been previously recorded as a liability in the prior year. In other words, this is last year's taxes. And last year we recorded the fact that we owed the taxes and that was the cost of doing business. So we recorded not only the liability, we recorded the liability, we also recorded the expense. In this particular case, now in the month of January, we're paying this tax obligation. So since we're paying it and analyzing this transaction, the assets, cash, are going down by $5,000 as we pay this, and that's a credit to cash, as it is to all assets. We're paying a previously recorded liability, so we'll simply reduce the liability to show that in fact we're paying it off or that it's being reduced. And the payment of a liability or a reduction of it is on the debit or left-hand side. The journal entry is to debit income tax payable to show its reduction, and to credit cash for $5,000 to show its reduction. The next transaction is for the payment of previously unrecorded January advertising costs for $3,000. Okay, apparently in this business we do some advertising and we pay for that advertising. In this particular case, we're cutting a check and paying $3,000 of cash for the cost of advertising. It has not been previously recorded. Some people might say, well, you owe for this advertising cost. But we've never set it up as a liability if we've never previously recorded it as such, and therefore we've never previously recorded it as an expense. So what we'll simply do here, and this is really the lazy man approach, we'll simply record the outflow of cash and call it an expense, increasing the expense by debiting it. Again, the journal entry is to debit advertising expense for $3,000 and credit cash for $3,000 to show the outflow of cash. The final transaction in this exercise, we pay cash dividends to the stockholders amounting to $4,000. In analyzing the transaction, cash is going out. That's a credit to cash to show that reduction of $4,000. Dividends are a reduction of owner's equity. The reduction of owner's equity through a reduction in retained earnings is shown directly in owner's equity as dividends, which is a reduction in owner's equity but is shown as an increase in dividends on the debit side. The entry here is to debit dividends and credit cash.